Welcome back to Stock Spotlight. I'm your host, Michael. Today, we're putting Napco Security Technologies, ticker NSSC, under the microscope. At first glance, Napco looks like a small-cap electronic security hardware company selling locks, alarms, access control systems, and fire alarm communicators. But the more interesting story is what sits underneath that hardware base. In Q3 26, recurring service revenue grew 15%, reached roughly 51% of total revenue, carried a 90% gross margin, and crossed a $100 million annual run rate. So today's question is simple. Is Napco still a niche security hardware manufacturer with unstable equipment demand, or is it becoming a high-quality recurring revenue compounder? Let's dive in. Before we get into the business, let's quickly look at how NSSC has performed versus the market. On a total return basis, Napco has been a major long-term outperformer. From April 1999 through May 2026, NSSC delivered a 19.8% annualized return versus 8.6% for SPY, with a long-term monthly correlation of just 0.27. That low correlation is nice, but the ride has been much bumpier, with annualized volatility around 48% versus 15% for SPY, and a current beta of 1.43. More recently, NSSC is up around 41% over the last year versus 25% for SPY, and 29% annualized over the past 10 years versus around 15% for SPY. Year to date, though, the stock is lagging, down around 7% versus SPY, which was up 9% as of June 24th, 2026, which was the time of this recording. So the setup is interesting. NSSC has been a long-term monster stock, but not a smooth one. And the current year-to-date weakness suggests investors are still debating whether the next chapter deserves the same premium as the last one. Napco was screened in October 2025 and earned a pass rating on my 33-question checklist with a 75% quality score. That puts them in the 84th percentile overall, the 76th percentile within their sector, and tied for 36 out of 259 companies that I've analyzed. So this is already a high-quality screen result. The question now is whether the fundamentals, valuation, and forward setup justified taking it seriously as a potential investment. Now let's begin with the business overview. Napco Security Technologies trades under the ticker NSSC and has a market cap of roughly $1.37 billion as of June 24th, 2026, which makes it a small cap company. GCIS lists Napco under the electronics general industry within the larger information technology sector, but for this episode, I think the more useful lens is actually what Stock Analysis uses, which is the security and protection services industry within the industrial sector. I would also classify their business lifecycle stage as profitable growth / mix shift growth. This is not an early stage company, but the mix of the business is still changing in an important way. One thing I found interesting when researching Napco is that they have been around much longer than I initially realized. The company was founded in 1969, incorporated in 1971, and then went public in 1972. For most of its history, Napco was a traditional security hardware company. But over time, it expanded through acquisitions like Alarm Lock, Continental Instruments, and Marks USA, which gave it a broader platform across the professional security market. And then from what I researched, the real business model shift started around 2012 when they began generating recurring revenue from cellular radio technology. And that really changed the story. Instead of just selling hardware up front, they could also sell the device and then collect monthly service revenue tied to that communication. And to me, the simplest way to think about the company is as a security layer for a building. So the locks on the doors, the access control system that decides who gets in, the alarm equipment that detects a problem, and that cellular communication layer that sends the signal where it needs to go. The value proposition is pretty straightforward in that they help professional installers secure buildings with an integrated set of products, and then they add a recurring service layer through cellular and cloud communication. They primarily sell B2B through independent distributors and dealers, and their business does skew commercial based on management's investor presentation, but some other markets are also institutional, industrial, and government. I then like to do a necessity rating, and I did rate them as having essential products. While not every product is legally mandated, much of what they create is closer to a need to have than a nice to have. One nuance worth flagging is that Napco may not be heavily dependent on one end customer, but they are exposed to large distributor buying patterns. And in fiscal 2025, management actually pointed this out, that reduced purchases from several large distributors as a reason for equipment revenue declining. So I would not describe the business as end customer concentrated, but I would describe it as channel sensitive. We've touched on it a little bit, but they have a hardware enabled recurring revenue model. First, they sell security equipment through the professional installer channel, and then they also earn monthly recurring service revenue when connected devices are activated for cellular or cloud communication. And that split does matter because equipment revenue is more cyclical and channel sensitive, while recurring service revenue is the higher quality piece because it grows with the installed base, carries higher margins, and becomes more predictable once devices are in the field. From what I can see, pricing power looks moderate to strong. The recurring service business has stronger pricing characteristics, I think, because it is mission critical and embedded in workflows, and then also tied to building reliability. And hardware pricing power is more moderate because from what I can gather, the security products market is pretty competitive. But then recent price increases and improving equipment gross margins suggest that Napco does maybe have more pricing flexibility than a typical hardware manufacturer. In terms of moat, I would call them a narrow moat business, and that comes from their product breadth, dealer relationships, and switching costs once devices are installed. Management's argument is also that they can offer everything under one roof, while many of their competitors rely on separate vendors across the stack. And this does make sense, and I would agree, but I don't think the moat is bulletproof, as it's still a competitive industry with a lot larger players, as you'll see in future sections of the podcast. Talking a little bit about their business segments and geographies, they only have one reported operating segment, which is electronic security devices, and it generated $882 million of revenue in 2025, which was down 3.8% year over year, mostly due to lower equipment sales, especially door locking products, according to management, and distributor destocking. The more useful investor lens is the revenue mix, and equipment or product revenue was around $95 million, or 52% of fiscal 25 revenue, while the recurring service revenue component was $86 million, or around 48% of fiscal 25 revenue. In terms of geographies, Napco is an overwhelmingly US business. It generated around 99% of fiscal 25 revenues, and that was down 4% year over year. In terms of R&D, Napco is not a software company, but R&D still matters because its edge depends on product innovation and that shift toward connected security devices. In terms of absolute dollars, their spend is small compared to competitors like Resideo, which is the closest practical public comp that I could find that also reports R&D separately. However, if you look at a percentage of revenue, Napco does screen better. Their R&D has generally run around 6 to 7% of sales, which is above Resideo and the industry average in my data set. The efficiency picture is more mixed. Napco's R&D efficiency peaked in 2023, but has fallen recently in the trailing 12 month as revenue growth did slow and R&D investment kept rising. Worth noting that Resideo has always maintained an R&D efficiency above 1 since 2019, which is rather impressive. So my read is that Napco is spending enough on R&D, but the payoff needs to show up in sustained recurring revenue growth and better equipment margins over the next few years. A brief note on supply chain and operations. Their manufacturing model is mostly in-house and heavily anchored by their Dominican Republic facility, which I think manufactures over 90% of their products. They also have a New York headquarters that houses R&D and technical support and corporate functions. And this DR facility, I think, is important because it does give them a low-cost manufacturing advantage and close proximity to the US. The trade-off, though, is concentration risk, as it is highly dependent on one manufacturing region. Let's now take a closer look at the landscape that Napco operates in. Overall, I would rate this industry as attractive, but competitive. The attractive part is that security demand is not going away. Commercial buildings, schools, healthcare facilities, apartments, airports, and homes all need some combination of alarms, access control, locks, fire communication, and monitoring. The less attractive part, though, to me, is competition. They operate in a fragmented security products and services market with much larger competitors across the market. Now, the good news is that the addressable market is large, but the exact TAM depends on how broadly you define security. Their own investor presentation breaks the opportunity into three major buckets: commercial security, which they have the North American market estimated at $121 billion and growing at a 7.7% CAGR; school security, which they have the global market estimated at $3.1 billion by 2027, growing at around 11% CAGR; and then residential security, which they have the US market estimated at $9 billion by 2026, growing at around a 12% CAGR. So this implies a broad opportunity of roughly around $130 billion across these three core markets. And with fiscal 25 revenue of only $182 million, their implied share is well below 1%. Forward company growth is also expected to outpace the broader industry. Stock Analysis estimates Napco revenue growing at roughly 12% revenue CAGR through 2028. And that compares to third-party industry forecasts, generally in the mid to high single digits. For example, Global Market Insights estimates the global electronic security market growing at around a 6% CAGR through 2035, while Markets and Markets previously estimated the commercial security system market growing at around a 7 to 8% CAGR through 2028. So based on current estimates, Napco is expected to grow faster than the broader electronic security market, but it still remains a small player globally. That leaves plenty of runway, but also means the thesis depends on continued share gains, recurring revenue expansion, and execution. Looking at the competitive environment, they compete across three security verticals, the first being alarms and connectivity, the second being locking, and the third being access control. For the financial peer set, I'm using 4 public comps: Allegion, Resideo, Alarm.com, and ADT. Allegion is probably the best comp for locking, door hardware, and access control, while Resideo is the closest practical comp for professional security products and that dealer distributor channel. Alarm.com is the recurring revenue and connected security platform comp. And ADT is the security services and installed base comp, though it is more monitoring and consumer service oriented. Now, based on my fiscal.ai peer table, Napco screens very well against this group. It has the highest 5-year revenue CAGR at 14%, the highest 5-year average ROIC at 44%, and the strongest forward 3-year revenue growth outlook at 12%. The main caveat, again, is scale, as Napco is much smaller than every comp in this group. So my competitive read is this: Napco is not the biggest player, and it's not the purest software platform, but it does combine above average growth, high returns on capital, and strong recurring revenue economics across several security verticals. And that does make it a differentiated small cap competitor in this large fragmented market. Now let's move on to the quality growth profile. This is scored out of 10 points across predictability, profitability, compounding, and value creation. The first question I ask Is 5-year trailing revenue stability at least greater than or equal to my portfolio average, which is an 84. We're now on a 0 to 100 scale. You might have seen in prior episodes a 0 to 1 scale. So on this question, Napco scores an 82, and this is using InvestorsGrow.com's revenue consistency metric that incorporates both trend and volatility, and the result here is no. And then question 2 is 10-year SBC adjusted free cash flow linearity greater than or equal to my portfolio average of 0.77. Napco also scores a no here as their 10-year SBC adjusted free cash flow linearity was 0.66. Moving on to profitability, they scored a 2 out of 3 in this section. And for question number 3, is 10-year median gross margin greater than or equal to 40%? And they did get a yes here as their 10-year median gross margin is 42.6%. And then for the 4th question, this is a new question that I've added. Is their average operating leverage greater than or equal to 1.0x with stable margin beta below 0.5? And so operating leverage measures how efficiently EBIT grows relative to revenue growth. And a ratio above 1.0 means that profit is scaling faster than the top line. But I want both profit scaling and stable margin behavior. So Napco's 10-year operating leverage is 2.1x, and they have a margin beta of 0.13, which screens as stable. That suggests real operating leverage, not just fragile margin volatility, and they get a yes for this question. And then question 5 is 10-year median SBC adjusted free cash flow margin greater than or equal to 15%. They got a no here as it was 9.1%. And then on the 3rd section, compounding, they actually got a 3 out of 3 here. So for question number 6, is 10-year revenue CAGR greater than or equal to 5%? And they got a yes because their revenue CAGR is 8.9%. And then question 7, is 10-year free cash flow per share CAGR at least 10%? And they definitely exceeded it here as their 10-year CAGR was 33.2%, which is one of the strongest parts of their quality growth profile. Then question 8 is 10-year median free cash flow conversion at least 75%. And it was yes again, as Napco had a conversion rate of 87%. Then finally, we round out with value creation with 2 questions. Question number 9 is 10-year value compounding rate at least 10%. And just as a reminder, value compounding rate is that reinvestment rate times ROIC, and it measures how fast a company can grow intrinsic value based on what it earns on capital and how much of those earnings it reinvests. Their 10-year compounding rate was only 0.4%, so they got a no. And then question number 10, has adjusted ROIC consistently exceeded the cost of capital over the past 5 years, while either improving over time or remaining sustainably high? They actually did get a yes here, as their current adjusted ROIC is 43% compared to an estimated cost of capital of 12%. And over the past 5 years, that adjusted ROIC has exceeded the cost of capital in all 5 years. So overall, they scored a 6 out of 10 on the quality growth profile, which is good, but not elite. And the most interesting tension perhaps is in value creation. They have a very high current adjusted ROIC that has cleared the cost of capital. So the existing business is clearly generating high returns, but the value compounding rate is less than 1% because of historical medians of around a 3% ROIC and a 12% reinvestment rate. Low ROIC and reinvestment rate means that the company has not been adding a lot of incremental invested capital, and the incremental capital that does show up has not translated cleanly into measured incremental NOPAT. Now, in Napco's case, that may partly reflect the business model. All right, so now let's quickly dig into their 3 financial statements to see if the numbers support the moat and whether all 3 are telling the same story. Before we get into the details, Just one note, I'll be using investorsgrow.com's 0 to 100 scoring system as a high-level starting point, and they have back-tested all three statements and found that the income statement and cash flow statement were better and quite high predictors of future performance. So for each statement, I'll share the company's score, explain the rationale, and then dig into what the numbers tell us. All right, starting with the income statement, Napco screens as a well-positioned with an investors.com Grow income statement strength score of 80. So the positives here are expanding gross margins, expanding operating margins, expanding net income margins, and strong operating income growth. Revenue has grown well over time, but it's not perfectly smooth. And gross margin is the real standout as it's moved from the low 40s range historically to the mid to high 50s recently, with trailing 12-month gross margin percentage around 57%. The COGS story is really two different businesses. Equipment costs are exposed to components, freight, tariffs, factory overhead, and product mix, while service costs are much lighter. The main income statement risk is really whether equipment volatility can offset the benefits of that recurring revenue growth. Moving to the balance sheet, Napco screens as strong with an investorsgrow.com balance sheet strength score of 90. And the main positives are low financial leverage, strong liquidity, cash and investments covering total debt, and low financial distress risk. Really, the headline here is simple. They have a fortress balance sheet. As of Q3 26, the company had $125 million of cash and investments against only $44 million of total liabilities. And debt is basically a non-issue. Their debt to equity ratio is 0.03. Their debt to free cash flow is around 0.09, and their cash to debt is nearly 24x. Cash has also grown from around 6% of assets in 2016 to now around 50% in 2025. Inventory is still worth watching because this is a hardware business, and inventory was around 33 million latest quarter, and days inventory outstanding was 136 days in 2025, which is down from the 2020 to 2021 COVID peak, but is still a meaningful number. The good news is that inventory and revenue as a percentage of change have moved in the same general direction over time with a moderate correlation of 0.40, and I do not see any glaring inventory mismatches right now. The main balance sheet caveat that I found is a $16 million accrued litigation costs that was recorded in Q3 26. So this is a real cash outflow, even though it does not threaten liquidity. So my balance sheet read is this. It's one of the cleanest parts of the Napco story. They have no meaningful debt, a large cash cushion, and plenty of flexibility for dividends, buybacks, reinvestment, or acquisitions. Finally, the cash flow statement. And once again, they screen as well-positioned with an investorsgrow.com cash flow strength score of 97. The biggest positives are that cash flow exceeds earnings, operating cash flow margins are expanding, free cash flow margins are expanding, and dividends are covered by free cash flow. So Napco generated around $56 million of free cash flow trailing 12 months through Q3 26. And that puts it at a free cash flow margin now of near 28 to 30%, which is excellent for a company with a meaningful hardware component. CapEx intensity is also very low. Their 10-year median as a percentage of revenue is only 1.3%. And so they clearly don't need heavy capital spending to grow the business. Stock-based compensation is also modest, and it's generally stayed around 1% of revenue. And as a percentage of operating cash flow, SBC was around 2% trailing 12-month, which is well below my portfolio weighted average. So my cash flow read is this. Another major positive. They convert earnings into cash, they require very little CapEx, and have low SBC dilution pressure. The key question is whether that remains true if equipment revenue becomes more volatile or if management starts deploying cash more aggressively. For Napco, I would track two primary KPIs. The first is recurring service revenue run rate, and this is the most important metric in the entire thesis. Napco's story depends on the company becoming less of a traditional hardware business and more of a hardware-enabled recurring revenue compounder. In Q3 26, recurring service revenue grew 15.4% year over year to $24.9 million, and this represented roughly 51% of total revenue and reached a prospective annual run rate of about $101 million. And what I want to see with this metric is recurring service revenue continue growing double digits, remaining around or above 50% of total revenue, and to keep its gross margin at the 88 to 92% level. The second KPI is equipment gross margin. This is important because Napco is not only a recurring revenue story. It still sells a lot of hardware, and that side of the business has been a source of volatility. In Q3 26, equipment revenue grew 8.4% year over year to $24.2 million, and equipment gross margin improved to roughly 29%. What I want to see here is equipment gross margin staying near the high 20s and ideally moving into the low 30s over time. There's also a third KPI that I'd watch out for, and it is MVP and access control recurring revenue contribution. This could become a future KPI since management has talked about MVP cloud access control as a potential new recurring revenue stream, but it is still a little bit early in the game there. All right, let's now talk about who's steering the ship at Napco. I've simplified this section going forward because the point isn't to recap every detail in the proxy, it's to answer the bigger question, and that is, are the people running the company aligned with long-term shareholders and making decisions that should compound value over time? All right, so the first thing I like to figure out is who's in charge. And now this is a founder-led business. Richard Soloway is 79 years old. He founded the company, and according to the proxy, he has served as chairman since 1981, CEO since 1998, and secretary since 1975. So that does give Napco a clear founder-operator profile, which I generally like to see. The only risk here is succession. When one person has been central to the company for this long, and also at his age, investors need to think about what leadership looks like after him. The 10-year scorecard for the rest of the management team is fairly strong. Their president and COO, Kevin Buchel, has been at the company for decades and does seem to have prior CFO experience. And then also their EVP of engineering and CTO, Michael Carreri, is a long tenured engineering leader with the company. One thing to call out, though, is their CFO, Andrew Viono, has only been with the company since 2025. So he is newer to the role, but does seem to have a long public accounting background. So the leadership classification overall is positive, but with a succession caveat. Now, employee sentiment is probably the weakest part of this section. Glassdoor only has 33 reviews, so I don't want to overstate the signal here, but the numbers are not great. They get a 2.5 stars out of 5, 31% recommend to a friend, and a 42% CEO approval, with only a 43% positive business outlook. Some employees praise the people, engineering work, learning opportunities, and the work environment, but negative reviews mention talent retention, old school management, and some employee trust issues. So my read overall is yellow flag. Now, looking at how they're paid, their compensation structure overall is what I would say directionally aligned, but not best in class. The proxy says that the executive compensation includes several different pieces, including base salary, annual incentives, and long-term incentives through stock options. The one thing to call out here is that the annual cash incentive is a little more discretionary than I would prefer. The proxy says bonuses may be based on targets established for the executives or on contributions to company profitability. So it seems like there's some link to performance, but I don't see a clean scorecard tied to recurring revenue growth, free cash flow, equipment margin improvement, or even shareholder returns. The long-term incentive piece is stock options, and I do like that better than pure cash because options only have value if the price rises. But again, it is not as clean as a formal performance share plan with explicit multi-year financial targets. They also have a pay versus performance table, which is useful here as it identifies net revenues and adjusted EBITDA as the company selected measures. And while these metrics do make sense because their strategy is about growth plus margin expansion, adjusted EBITDA is not my favorite one here. So overall, I would say the compensation is reasonable, but definitely not elite. Looking at capital allocation, I have them as good with one preference caveat. So Napco does not have a Morningstar stewardship rating, but the evidence is generally positive. The company has no meaningful debt, a large cash balance, and generates positive free cash flow. They've reduced diluted shares outstanding by around 5% over the last decade and used a decent amount for buybacks. One caveat, though, that I don't really like is that they do pay a quarterly dividend. And while this dividend is covered by free cash flow, it's not my favorite use of capital for a small cap company that, at least in theory, should have a lot of growth opportunities in recurring revenue, MVP access control that they talk about, and just general product development. So my read overall of capital allocation is that it's generally been conservative and shareholder friendly, but I'd rather see them prioritize reinvestment and disciplined buybacks over building a dividend identity too early. Looking at insider ownership, it's meaningful, but not controlling. The latest 14A proxy shows Richard Soloway owning around 4% of shares, and all directors and executive officers as a group own between 5 and 6%. Institutional ownership is also high. The proxy lists Vanguard at 8%, BlackRock at 7%, and they're the two 5+% shareholders. And my other sources show institutional ownership in the mid 80s range. So the shareholder base is definitely heavily institutional. Now let's move on to valuation. For Napco, I'm using two main valuation methods: enterprise value multiples and a yield approach using free cash flow yield and owner earnings yield. I'm not using a full DCF here because Investors Grow does not have analysts' free cash flow estimates for Napco. And I'm also not using a market implied cap because their ROIC and reinvestment rate are noisy. So the valuation question here is going to be simpler. What multiple is the market placing on Napco's current and forward operating earnings? And what cash yield am I getting today? For the multiple method, I'm using EV to EBIT. I recently built an EV multiple selector model to help choose the best enterprise value multiple for each company based on their last 10 years of data. And for NSSC, the model selected EV to EBIT as the best candidate. The model showed that enterprise value has historically tracked EBIT quite well, with a 0.86 R squared between EV and EBIT and a 0.93 correlation. And their 10-year median multiple was about 33.5x. Now, as of June 26, 2026, they traded around $37 with a market cap of $1.32 billion and an enterprise value of $1.22 billion, using trailing 12-month Q3 26 EBIT of about $55.9 million. The current EV to EBIT multiple is roughly 21.8x. That is lower than their 3, 5, and 10-year median EV to EBIT multiples, which were at 33x, 36.1x, and 33.5x respectively. If you use those historical median multiples, the implied stock price range is roughly $54 to $59. That sounds like a lot of upside, but I would be careful here, as those historical multiples were helped by high investor enthusiasm for the story. The current market may be assigning a lower multiple because equipment revenue has been uneven and investors still remember the 2023 accounting restatement and internal control issues. The 2023 accounting restatement and internal control issues. I also added a forward EV to EBIT section because Fiscal.ai provides a next 12-month forward EV to EBIT multiple, which in the case of Napco is 19.4x. So using their current enterprise value of $1.22 billion, we can back into an implied forward EBIT estimate of roughly $62.7 million. Now, if you apply those same 3, 5, and 10-year historical median EV to EBIT multiples to that forward EBIT number, the implied stock price range is roughly $61 to $66. So the market is currently valuing Napco at a much lower forward EV to EBIT multiple than its historical median. The second valuation method is a yield approach. Napco's cash flow quality is strong, and Investors Grow shows the company's 20-year rolling free cash flow stability score at roughly 89 out of 100 on a trailing 12-month basis, which is quite strong. For the yield approach, I used an implied 2026 expected free cash flow estimate because my usual source only has limited forward free cash flow coverage for NSSC. Based on a current enterprise value of $1.2 billion and next 12-month EV to free cash flow multiple of 25.1x, the market is implying about $49 million of forward free cash flow. I also calculated owner earnings using 80% of total CapEx as maintenance CapEx. So between the two, that gives Napco a forward EV to free cash flow yield of about 4% and an owner earnings yield of about 3.7%. That is not screaming cheap, but is also not crazy for a company with high recurring revenue, a debt-free balance sheet, and double-digit expected growth. So my valuation conclusion is this. Napco does not look obviously expensive at 37, especially relative to its own history, but it's also not cheap enough to ignore the risk. Before we get to the verdict, let's talk some technical analysis. I want to be clear about what technical analysis does and doesn't do in my process. It doesn't change the fundamental thesis, but what it does tell me is whether now is a reasonable time to act on that thesis and where the logical entry zone could be. Think of it as a timing and risk management layer on top of the fundamental work we've done. As of June 26, 2026, NSSC was trading around $37, and the most important area in the chart looks like the $39 to $40 range, which lines up with their 200-day EMA, the 50-week EMA, and a meaningful volume profile area. Near-term support looks roughly in the $35 to $36 range, where the stock has recently bounced. Below that, the next bigger support area looks closer to the low 30s. Also, the 14-day ATR, or average true range, is about $1.34. So normal daily movement is still meaningful for a stock in the high 30s. Overall, on a price basis, the trend is still weak. On the daily chart, they are below the 50-day EMA and the 200-day EMA. And the 50-day EMA is also below the 200-day EMA, which tells me that the shorter-term trend has not repaired yet. On the longer-term weekly chart, the stock is also below its 20-week, 30-week, and 50-week moving averages. The 30-week EMA is also declining, which is one of the main reasons the longer-term trend still screens poorly. So taking this all together and then looking at my price stage model, Napco would currently be classified as a stage 4 downtrend on both the 1-year daily chart and the 5-year weekly chart. We've covered a lot of ground today, so let's bring it all together. At the start of the episode, I asked, is Napco still a niche security hardware manufacturer with unstable equipment demand, or is it becoming a higher quality recurring revenue compounder? Before I give you the final call, here's how Napco stacks up for me. With their initial quality score, they got a 75%, which was a pass, and putting them in the 84th percentile overall, and 36 out of 259 companies analyzed. In the more focused quality growth profile, they scored a 6 out of 10, which I would call adequate to good, but not elite. Now, what was elite was their financial statements, as they scored strong across all three, and consistency across them is also mostly aligned. Looking at leadership and incentives, they are founder-led with a long-tenured management team outside of the CFO. And while no Morningstar stewardship rating is available, I would call the overall evidence mixed to yellow. They definitely have strong founder continuity, meaningful insider ownership, and shareholder-friendly capital allocation, but it's offset by some succession risk, weak Glassdoor reviews, discretionary compensation, insider selling, and less than perfect governance. From a valuation perspective, they are fair to modestly attractive at around $37. And the biggest risk that I see with the business are equipment revenue volatility, distributor ordering patterns, recurring revenue growth slowing, succession risk, and lingering trust issues after the 2023 accounting restatement and internal control weakness. After the 2023 accounting restatement and internal control issues. Now that we have the weight of evidence, the next question is what return the stock might deliver. I'm underwriting NSSC through a 5-year total shareholder return model. The model starts with a total free cash flow forecast, estimates the future share count using my annual buyback yield assumption, and then calculates future free cash flow per share. So in simple terms, it's year 5 free cash flow divided by year 5 shares, which gets us year 5 free cash flow per share. and then I apply an exit price to free cash flow multiple to estimate the year 5 stock price. From there, I compare the implied year 5 price to today's price to calculate that annualized return. So my base case is a 24 times price to free cash flow exit multiple, gets us at an implied year 5 price of $60.84 and an implied 5-year CAGR of 10.4%. I also calculated the price I'd need to pay today to hit my return hurdles. For a 12% hurdle, the price would need to be $34.52. And if I wanted a 15% hurdle, the entry price would need to be $30.25. So if you weight the bull case 25% and the base case 50% and the bear case 25%, I get an overall probability weighted 5-year CAGR of 9.2%. So the TSR model says that NSSC has a reasonable return setup, but not a screaming buy at today's price. The base case is below my 12% hurdle, and that probability weighted return is also below the hurdle. For the full TSR spreadsheet model, check the Substack post that will follow this episode. So at today's price of $37, this is a watch for me. I like a lot about Napco. It is founder-led, debt-free, highly profitable, cash generative, and the recurring service revenue story is real. I also think it's under-discussed for a small cap company with this kind of margin profile, and the business could be strategically interesting to a larger player. But my hesitation is competitive durability. Napco is still a small fish in a very large and competitive security market, and I'm not fully convinced yet that its narrow moat is strong enough to protect the business long term. So what can move this closer to a buy? Either a price in the low 30s, where the TSR model gets closer to my 12 to 15% hurdle range, or more evidence that recurring service revenue can keep growing double digits while equipment gross margins holds in the high 20s or better. And that's a wrap on today's Stock Spotlight deep dive on Napco Security Technologies, ticker symbol NSSC. And if you found this useful, the best thing you can do is leave a comment or vote in the episode poll. Our next 2 episodes will feature guest interviews on Rivian and Mercado Libre, ticker symbols RIVN and MELI, before we get to other investing topics. Until our next episode, keep your process sharp, your standards high, and your portfolio intentional.